There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome traders, portfolio managers, campers, financial planners. Oh, sorry, that's just all my roles. In any case, this is Steve Vetterl, managing partner, First Down Financial. I'd like to welcome you to the Tuesday, a rare Tuesday these days, broadcast by myself. I'm going to go over a few things here. Wanted to, been just really totally tied up with a whole bunch of stuff going on, especially since Chairman Powell's speaking right now, and the market's just going wild one way or the other. And, you know, honestly, with the news that's going on right now, so it looks like he's just an economic club of Washington. These are usually, but we've had, you know, if they continue to get stronger labor markets and higher inflation, may need to raise again. So that's why the market was racing up on some of his comments earlier. And now the global equity markets in the developed arena, at least the ones that are still open, primarily here in the U.S., and we are the New York time zone here in Eastern time, they're getting clobbered. So, and it's a fluid situation, as you can see. Just understand on this pattern here, I'm not going to get too much in this because I have really delved into just a ton of patterns. I'm going to speak just more generally in macro today. But there's just been a ton of patterns where you've had, you know, just trying to get higher and higher, and you're finishing at the lower end, or in this case, in engulfing candle, one that engulfs the previous day, starts off higher, may not be the easiest to see, but it's engulfed the previous, almost the previous 3 days, and then it finishes lower, right? That's a bearish candle. So these candles on this chart at least are dailies. Each one represents a single day of the S&P. So, but just take a look at the news as I touched briefly on Saturday. You know, we're not finished with Fed speakers. Williams talks tomorrow. And, you know, if you don't know who he is, he's the Fed governor, and also he's the president of the New York Fed. He's going to be talking economic outlook, an interview conducted Wall Street Journal at the CFO Network Summit. So I would keep an eye on, you know, what's going on there. I don't know if he echoes the same thing. Maybe it's taken the markets down from a rally situation we were at. It's possible that it'll, you know, be the same. So I'm going to go through with you guys a couple of things here I thought that was interesting. For those of you who don't know what this is my Twitter handle. It's at FXESTrader right here. I've been doing this since 2009 on Twitter. The thing I really try to do on Twitter, and I know this is going to seem like a total broken record to some of the people, we have a lot of new people in all walks of life that follow this cast, whether you're a Auvoria subscriber, you're a, you know, a client, students. We have a lot of outside advisors that partner with us. We do a fair amount of work with them, trying to help them close business and put case design together for clients. So I try to speak in real generalities, at least most of the time. I do a fair amount of the drill down sessions on Saturdays, but in this particular case, almost exclusively outside of a couple of funny people, the 256 people I follow on Twitter, they're typically the best at what they do. So, and many of them are far smarter than myself. Case in point, Cassandra BC. You guys don't know who this is? This is Dr. Michael Burry. So he is the movie that they wrote about. It's called The Big Short. If you haven't seen it, I would highly suggest this movie was probably top 5 all time, along with a couple of the Rodney Dangerfield movies. But outside of that, this is basically an entire, everything this guy does has just been spot on. Not as much recently, but historically, some of his insights just bananas. And he takes these tweets down immediately in some cases. He's keeping more of them up. I think that they've convinced him with, Elon's ownership of Twitter, that it's worth keeping some of these tweets up. But, there's been a lot of comparisons to previous market runs. Many will discount that. I could tell you that the markets always have a tendency to form the same patterns, just from the single standpoint that it is a self-fulfilling prophecy. Okay? So, kind of where we went, and then the markets went back up, and then you can go to the next chart, and this is an overlay of what took place in 1929 right here. So, which was the Great Depression. It's the biggest hit the markets have ever taken. Now, in all fairness, the markets have raced up tremendously, and this was just the S&P 500. It's always hilarious to look at the S&P in double digits. Isn't that crazy? It's in a 4-digit capacity now, but it was double digits back then. But so it was officially, S&P was officially created in 1957, but data from the predecessor index and companies it tracks goes all the way back to 1871. So the data is compiled in the chart you see above and represents an accurate picture of what happened in 1929. So both 29 and 23 are an end of a disinflationary cycle. And it's, essentially to these patterns, they are much, much longer term. We're not banking anything here in this cast or suggesting you bank anything based on this. I just like to render people's opinions that are far smarter than me, and in many cases do this for a living all day long. So one of the best guys I follow is Carlo Cassio. If you don't know who he is, there's a lot of comedy in this, but guy's actually an excellent macro analyst and a trader. You follow him, you'll see some of the stuff. He has a lot of private stuff. I am a member of Kitty Squiddy. This sounds ridiculous to say on a podcast because it's all kitty cat based crap. But there's 1,000 people on this closed Twitter. We had to donate to some charitable cause and be sort of worth it, at least to Carlo and his henchmen to get on this. The information coming off of his feed and some of the contributors has just been absolutely spot on. I mean, these guys are just banking coin. I don't own this. I don't get endorsed by it. I have, if you're not sort of dealing with it correctly and you're being a jerk on the feed, which I don't really do anything like that publicly, but a lot do, you get kicked off the feed. And in any case, it's, one of the great things about winning a whole pile of awards here is it affords me the ability to follow and get on some of these lists. Why is that important? Well, these guys have done a mass load of work that I just don't have the time to do anymore, right? And, the funny thing is with this current marketplace, and I'm just put up a good chart for you here. This looks like a bearish running triangle here, but outside of this chart, absolutely nobody can agree on anything on what's happening with the economic and news right now, right? So we might need an addendum to the old age that, there are decades in which nothing happens and weeks in which decades happen, right? So apparently there's also weeks where nobody knows what in the hell is going on, like last week was one of them, right? So the Fed rate hike, acceleration slammed right into a Bureau jobs report, that BLM report, which was real positive and totally unexpected. So arguably proof of an economy still running hot, was the, sort of the, the rumor, if you will, last week. But, it basically rocked everyone's baseline outlook, and now short sellers are scrambling to cover, whatever shorts they've built, as we're seeing some craziness up here. So, if you don't know what happened last week, the January jobs report saw 517K non-farm jobs added versus 187,000 expectations. So that actually blew away the number. I mean, it was a monster out. Now, as I said on Saturday, I've somewhat discounted this because I don't think to those that were really digging around in jobs numbers, this would have been that much of a surprise. Certainly did surprise the upside. But I mean, there's a lot of people running out of pandemic money. So between myself and all the advisors that we work with, including clients, and we probably talk to hundreds of people a week, and many of them have some, relative that's like, yeah, they're out of money, they're going back getting a job. I mean, I heard that just a ton, just in my daily channel checks and in finding out what's going on out there, right? Just in discussions. We're on the phone basically all day, or we're in Zoom presentations, or we're in client meetings, or we're talking in front of whatever group, mostly a recent client, the U.S. government, about all this stuff. So, the result's like a big question mark. It's like an outbreak of Wall Street head scratching and really nothing close to any kind of consensus on what's going on. So, but here is the thing. So companies in the S&P are projected to see a year-over-year fall in profits, but that could be completely wrong. Why? Because there's a whole bunch of more people coming back and getting in the workforce, right? Arguably their income is going to be going up. The ridiculous amount of consumer consumption in this country, it could actually accelerate, in which case earnings could be higher than expected, right? At the same time, the Fed's raising interest rates. So it's kind of, it's weird, and yet in the market's, essentially strong enough to stop short selling firms in many of these rallies. So suddenly glass half full crowd just executed its largest burst of short covering since November of 2015, right? That's according to the Financial Times. So at least one prominent bear is going cautiously optimistic. I hold absolutely no interest in anything Lawrence Summers says. You remember, he used to run the Treasury a long time ago. I think they had running water back then. Ha. But, he's in most of these people that don't have a track record, of which, by the way, I don't follow any of these people on Twitter. The more they squawk about the world's coming to an end, black swan this, you name it, and all these events, the more it sells subscriptions, right? The more it sells books. So the problem is there's been so much of that fear-mongering out there across all kinds of spectrums of interest socially. It's created a lot of doubting Thomases among many of us, including yours truly. So that's kind of all I wanted to say about what's going on big picture. You can see the Twitter. Let's take a look at some currencies real quick. I always like to start off with the dollar. I mean, why is this a surprise, right? So you can even go jump between a long bond chart. See, this has just jumped down a bunch, right? And the dollar, okay? You can jump between the DXY, TLT. You can jump between the 30-year iShares and the dollar, right? You can jump between gold. You can either use the GLD or the spot market. In this case, I'll use spot. And you can see what's going on here. This is quite noisy. It's best looking at a weekly chart, in my opinion. I know it seems like a lot of folks out there are like, well, why do we care about gold? You do, because it's a correlated head commodity, right? At least in the metal space, gas, crude, head leads in the energy space, right? And then you have, obviously all the rest of the commodities. But I always want to know what's going on in I don't really care about a lot of metals, but I do care about what's going on in gold, which typically swings into silver, and then a lot of the other metals, especially platinum, are really kind of on their own. But in terms of the correlations with how everything's flowing right now, right? So interest rates going up, had just an absolute rip into an area where obviously there's a lot of sellers still sitting, right? So from a charting standpoint, had you been lucky enough to get in around this 1630 here, and I never got a fill on this trade because I had a GTC order just down here on GLD waiting to get filled right around 1600, never filled. I canceled it because you don't want to, buy it again back down and see what the patterns look like. But it would have been a great trade, right? And I'd have been out of most of it right on this move because there's obviously still big institutional sellers. These are the time frame players that are up there sitting, waiting for that. But if you take a look at, what's going on, you can jump back to the DXY, not the DAX. Let's take a look at the DXY. So if you want to go back on Saturday, I'm not going to redo all these charts right now, but this is the big support area right here at this 102. Big support. Doesn't mean it's going to hold, right? Everything we thought was going to hold on the way up didn't hold on, and it kept going up and up and up, and now you had that sort of crescendo top, and then a big distribution here as rates have sort of swung the other way from the ridiculous tightening cycles. But now as we're getting a bit of a rally, and remember these are weekly charts, guys, so if we drop to a daily, do a refresh, you kind of see where from the top point, at least from a daily perspective, there's more confluence here at this support zone, this whole area. So this is a pretty strong zone. I would look this at the bottom. Up top, it's essentially right here, 105. All right, let's take a look at, what else did I want to address? Oh, you know what? I don't know that I saved this. Okay, let me take a look at this on, bear with me 1 second here. I'm not sure I saved it because I think it's on, let me look at one thing. It was, I thought one of the better explanations, this finance a lot guy's got a pretty big following. Let's see if I can find this. It's got some pretty funny stuff on here, but, and I don't know that I have, oh, here it is, cool. All right, so this is, if you guys can see this, this is an economic cycle, okay? Start off at the bottom, where you get into the bottom essentially, and then you move into, and keep in mind this is more of an equity just discussion here, but I mean you have commodities will top at certain times and the market's obviously at a top, right? But the point of this is that from the standpoint of those trading the Dow 30, most of the 11 sectors, there's actually a few more sectors, but most of the 11 you see on this screen is represented in the Dow 30, right, or the US 30. I don't like that index in a whole, but it's pretty fun to trade on the MT4 platform, right? So just understand if you're coming off of a bottom and you come into an early bull, what performs the best, right? Well, typically financials do, especially if there has some changes in the yield curve there. But transportation, right? And then you usually will have technology, which typically can catch quite early, right? Especially the hottest or the best stuff, best chart patterns in bear markets, right? There are always ones, if there's a decent enough bottoming process and breakout in place, like a cup of handle, then that chart pattern can prove very powerful in an early bear market, an early bull market. We're in a bear market, but this is a discussion of the early bull market. So in any case, this just shows you. I can actually put this up on, I think I'll put this on Telegram. I thought this was really good. That just shows you, what typically happens. So if you're somebody that actually, want to do a deeper analysis, and just know that usually the last to peak are energy stocks and then the metals, okay? And then as things begin to roll over, you typically will have consumer cyclicals, and then 10 utilities, and these are the things that are certainly holding strong. And then you can see consumers. So essentially the last to go is the consumer market. because these are, I'm not going to say recession proof, but everybody needs toilet paper. At least I hope they do. And that's kind of how a full market cycle works. In this particular case, starting at the beginning of January, as I talked about way back then, I expected number 5 to be first. Tech got clobbered in this early. Now, tech arguably was also the most oversold, right? So it's gone up the most in most cases. So with tech, it staged a pretty good comeback this year, obviously, as it typically does. So I would, historically, this may be the case. This is obviously what took place in 2007 into the peak. And then this particular point down here was March of 2009 when we caught that. And it wasn't really a turn, it was more like a V bottom, kind of like we saw back in October, which is all based on the Fed pivoting, right? So this next one here overlays inflation, okay? So growth versus trend, and even though you may not, understand this fully as it plays out, I thought that I'm showing what our finance guy said. Technology and financials rallying are a sign of another mini bull run, but make no mistake, we're still at the end of the large economic cycle, right? So as inflation comes down, and the interesting thing is, so here's the rate hikes, right? But inflation had already precipitated these rate hikes. So you can actually almost shift this line over into, a little more towards the center. And the point is now you get an overheating, and now the concern is even with rate hikes, you've got inflation going up and rate hikes going up, right? As they start to come down, you're having stagflation. This is a problem. Stagflation is almost as brutal as deflation, right? Because deflation hits, oh, wait a minute, Steve, deflation makes commodity prices cheaper. Yes, it does. But if the commodity prices are deflating, so is everything else, including demand, right? So it can be just as powerfully destructive on the downside as stagflation is on the upside. So, and this really isn't anything about just a master class on, hey, you really need to understand this, but the more you can put context surrounding what's going on with this, the more that it's much easier to frame things that Powell says or changes, or why did the markets do this? Because in the end, in my opinion, the education of, or I should say the culmination of all this education, is the simple fact that you can sit down in any given time, do whatever amount of research, and form a thesis and put together a couple of what-if scenarios. And when you get to that point of what's called envisioning, as I call that final stage, you have an idea what's coming down the pike. Then you feel a lot more comfortable. Yes, you could be wrong, but it's all about statistical percentages, how much you're going to be right on this, right? Just like a win rate on any algo or any kind of trading system, right? It's all about win rates. But as long as you can win more than you can lose, and you're keeping position size correct, you're going to make money. So I always believe it starts from the very, very macro, I should say macro into micro, and then you can move into all the other things that I teach you guys about chart patterns and so forth. So we'll let that be our short little message today, but I didn't really want to go into a lot of charts. I do want to show what's going on with the euro here. Moderately inversely correlated to the DXY, fairly inversely correlated, not perfectly, but essentially we've had a big pull down, and we're on, I don't know if this is even the right, yeah, that's fairly accurate. I only care about data on the profile here on the left market profile chart. I only care about data that's encompassed in the entire move, right? So in this case, we're April of last year, less than a year. So it just aggregates at the value area high. Notice is a complete reversal for us. Market profile works. If if you set the profiles up correctly, in my opinion, the profiles set correctly up as longer term. You can always use it in a short term too. These work pretty good if you're trading based on volume, but this works actually really well in the futures markets. But if you're looking to just chart stuff and look for support and resistance in any kind of context, confluence, where lots of stuff shows up at the same, then you just want to look at the full data that's been in this entire range since we got into the range, right? And in this case, longer term, we've got into this range right here on about the 7th of April last spring. So we started coming down from previous range, but you can continue to bring more range in, but then you're bringing in data for a range that's much higher. See? So I just only believe in this case, April 7th, somewhere in this area, you want to keep data in there, kind of like you see right there, right? This is kind of the same argument for why I don't have them here because there's just too many things on this chart, but it's kind of the same concept. You really only care about an aggregate of data from a certain point, right? So another real powerful thing people will do is they'll use what's called an anchored VWAP. So in this case, you take the bottom of the market, right? It's 28th of September of 22 last year. And you would anchor the VWAP here, and then the VWAP probably would look something like this. I should probably have this toggled set up. I have it on my other system, but a lot of times I don't show you guys all the stuff I do because one, it's on another system, and two, I don't broadcast from that. That's just for trading only. I don't trust anything that gets in connection with my trading system because it trades a lot of the firm's portfolio. I want it being completely autonomous from anything that serves the web. But in any case, the VWAPs are real powerful. So you'd anchor it here. You can anchor them from anywhere. You can anchor the VWAP from here if you're trading more short term. And hell, if this is the bottom, you can anchor the VWAP here, and going forward, it's not going to provide much data. But some people will look at anchored VWAPs and then run a market profile from the base of the movement. That's okay. It's just a different data set. The only problem with that is it doesn't encompass everything that took place in that particular range, which may not be a whole year, right? Maybe your range that you're on, like in the British pound, it's about the same time. Maybe you'll just, show GBP while we're on the subject. See, I only care about the data in aggregate, not up here, but I want to stretch this chart out a little bit more and just bring in the data from when we're in this range, right? If you get this lined up pretty good, you're going to see that most of these developed markets in any arena, if there's liquidity, and if it's honest and good data coming in the aggregate, you're going to see that price action pays very close attention to where these lines line up. You'll see a lot of stuff hovering around a center line, which is called a point of control. You'll see the value area high, which is about 70% of all of the range, is to the high side. So you're saying, well, where did everybody, in this case, Steve, execute? Well, they executed all across the spectrum, but the most executed trades in this particular pair at 121.85 over the last year, right? What this can also tell you is that, let's say this whole half of this chart I'm circling doesn't exist, right? And we're just looking at the bottom here, we've bounced up. And let's say the POC was still here. Well, what's that tell you? Well, that would mean that in most cases, the folks that were going long here, this is more of a go short pattern at this point, but if you were trying to go long, you were still holding, they all got flushed out right here. So the argument would be like, well, we just had an absolute crescendo moment, right? Watershed, whatever you want to call it, and that sets the bottom for now. One thing I will tell you, and I don't know if that's really going to come to fruition, but down here at the very bottom of this, we had a very incomplete auction. And one of the core tenets of AMT, or market profile, auction market theory, is that incomplete auctions will always be completed at some point. Problem is nobody can determine if, when, how, why, all that. But much of the wreck in the 1987 correction completed the auction that was incomplete from the 70s. Isn't that nuts? So, there's always plenty of times where people say, well, we didn't go back down and complete that auction. Yep, but eventually we did. And for all those naysayers throughout the 2000s or throughout the late 90s and into the early 2000s, and everything was just absolutely rocking before it wrecked into the bottom of '03's tech wreck, every single one of those incomplete auctions was completed to the downside. So it went in and filled in missing notches, as we call it, and then it allowed it to have a complete auction. Then you could see, well, maybe it'll stand on its own ground here, and then it can begin to move higher, in which case you have a much more true, stable, long-term downside target. And with that, if I haven't thoroughly confused you yet, maybe I will in the next call. But if I have, apologize. You can always listen to these casts in infamy, hopefully. And if you guys got any questions at all, feel free to send me an email.